Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and today we're continuing week number 5 of our 52-week challenge of the 2026 Weekly Dividend ETF Challenge. Now, if you're not familiar, I have basically taken $10,000 of my own money, put it into the select funds to find out which funds work, which funds don't, to try to see if we can generate a regular income from these funds, or are we just in a yield trap that just struggles to make any money any which way? So I want to put a thought out there and just thank everybody who's in the Patreon. Thank you for your support. And all of our YouTube subscribers, thank you so much for being part of our channel. So let's get into today's update of week number 5 of the 2026 Weekly Dividend Challenge. So before we get started, we have to do the investment disclaimer and the risk warning that this video is not for financial advice. This channel is purely based on my own thoughts as I navigate my personal investment journey. Please always do your own research before investing in any single stock ETF. I am not a licensed financial advisor. If you need financial help, always contact a financial advisor, as I am not liable for any investment decisions that you have to make based on this information going forward. Let's get into the breakdown. So the 2026 Dividend ETF Challenge is the high risk, high reward experiment to beat the market with leverage ETFs. Now, to give you some, update and redo of what we have, our strategy outlay is we're putting $10,000 of our own money across 10 different ETFs for a total of investment of $1,000 in each. Our goal is the weekly dividends, and we're trying to get some growth in the stock across the board. So the hypothetical goal of the challenge is try to achieve a weekly income of 25%, a total return of 31%, and a growth fund of 6%. Now, we chose not to do drip, but because of what you guys all said, you wanted to see it, we've doing a synthetic type blend with dripping allowed. It's not that we're dripping our money. What we're doing is we're doing a math calculation. I'll show you that here shortly. Now, the risk factors of this: leverage ETFs amplify both the gains and the losses, and it concentrates on the portfolio, increases volatility, and the option-based strategies. And the tracking approach is, like I told you, we were going to show you weekly dividend tracking, real-time performance monitoring, and give you basically the viewer feedback incorporated into it. Already you guys asked us for drip, we're doing drip. If you guys tell us something different, we're going to try to add it into it. And I have to say again that this is not financial advice. I'm investing my own money and showing you what I'm doing with that money as we go through this. And if you haven't seen it, but what we did, and I'll actually post the very first version of this in the comments so you guys can quickly see it and get caught up. But our final portfolio is that we did a broad across that we used Roundhill, Yield Max, Rex shares, even Granite shares across the board. We tried to do things equally. We did not try to duplicate like, everything goes into AI or everything goes into tech or everything goes into Tesla. We tried to spread it out. And, honestly, it was a tough thing to do because I felt that we had more room to play with, that we didn't get the stuff like Amazon and some of the retail stuff. But what we got here, as you can see, we took $1,000 in each fund. We got number of shares, the price that we paid. And, some of the things that I was excited about, AMD was one of them. Google's another one. The gold side of things was another one. So we have a lot of pieces of the puzzle. Also, we put that TDAC and TSYX, put into that one, and just try to get that leverage of those two new funds. So let's take a look at how we did. So now taking a look at the funds, how everything did for this week. You can see GOOW came in with the highest at 63 cents. The TSII came in at 26 cents. That's our new fund that we added in last week to replace HOOW. So that's already been a positive move there. We've actually added a little bit extra cash to it because the price currently went up from what we purchased. So I was pleased with that one at this point in time. Across the board, though, as a whole, we are in dividends, we are down $13.14. So that was a huge drop off, lower dividends this week than we were last week. The fund itself is still down $1,500, so we're down 15.07%. The only two that have actually in the positives is Chippy and the gold miners, GDXW. So after 5 weeks, we're actually in the hole, $1,500. We've collected almost $959 worth of dividends. So I'm very pleased with what we've collected so far. So bottom line is we're still down $546.79 or down 5.47 so far in our weekly challenge. So again, it goes back to, as I've said on this channel numerous times, total return means everything. We can be sitting there saying, wow, we're collecting 9% over 5 weeks, but we've lost 15% to get there. So you're losing money on the weeklies. Now, if we took around and dripped, this has been the big question. If we drip 100%, what is it going to look like? So again, what we're doing is we're taking those dividends, we're buying new shares, as many as we possibly can. The big one, again, TSYY, we're able to buy a little over 5 shares. We're almost to that 6 share point, but 5 shares per week. So we continuously add into that fund, even though it continuously drops. So after 5 weeks, our net portfolio is actually down $1,033. So it is a little over almost a $470 difference between dripping and not dripping. Our dividends actually, I think we're off just a little bit in the calculations, but we are actually up this week, $1.53 because of that dripping factor. And our dividend total is $966.77 at 9.67. So realistically, total return, we're down $66.84 or 0.67%. So the 100% drip is actually almost balancing us out. We are so close right now balancing it out. So it tells me that you need to definitely drip away on these type of funds. When we look at it, you can see Chippy and the gold miners and actually AMD are now actually above the $1,000 that we originally did. But we're not getting the income that we were needing for, I'll call it for retirement. All this is doing is building a portfolio. And truthfully, in 5 weeks, it's lost money. So let's take a look at the individual data and going down this route as I see right now. And we see AMD actually recovered a little bit by almost $6 million. GOW actually come down a little bit. I primarily think that's because of the dividend that was paid out. GDXW recovered. That's back up. Robinhood we're completely out of, but you can see it dropped again. NVIDIA went up to about $5 million. So across the board, pretty comfortable with what the assets under management have actually done. The funny one is TSYY. We keep talking about that one. It's only down less than $1 million. So I'm pleased with that. But when we start looking at these total returns again, is mind-boggling. The numbers change very quickly. So the new total returns, the big one to look at again is Chippy is now up to 32%. Gold miners back up to the 30% mark, which we like to see. Google at 29%. And AMDW actually is now up to 13.27%. So it really is telling me in the total package here, guys, is that there is only a handful of weeklies that you really want to be invested into. These are the key factors that is total return is telling us everything that we want to know. Is there any of them there on the warning list like HOW was? Not at this point in time. I'm pretty pleased. I'm going to TSYY. This is the thing I think I got a couple of comments about last week about how is this? If you're down 82% total return, how in the world would you hold on to that one? And it really comes into that dividend side of it. I really, in my gut, tells me at TSYY, Tesla is going to have a rebound here. within the first quarter. That's just my own take. It's nothing that you go home on. I'm not a finance guy. I'm not a stock guy. I'm just an individual, independent guy, and looking at what Tesla's doing, news cycles going on. The assets under management are not going down dramatically like we saw with HOW. The total return is definitely making some big movements, but again, that goes with price shares. The price was down, almost $1 a share, and I think that's what made the big drop off. But again, recovery is always a big thing. That's why we like doing the drip onto it. So a real recap of the funds. Our total return winners, Chippy, still holding. It took over number one spot, holding number one spot. The gold miners, GDXW, holding there at 30%, and Google is holding it at 29%. So those three, hands down, are right now is our winners. That's why I say I think it's only a handful of funds that you really need to worry about in the weeklies. Everything else, I would not put money onto. The yield winners, TSYY granted shares, yes, they pay out huge dividends, but I think they're losing so much on the total return side that it's nice, but I just don't think it's where we want to be. Eli Lilly at 1.85, and again, both of these are rec shares at 1.15 for the Tesla. Total winners so far, the gold miners X, $83.44 of net profit. Chippy is at 15.78. And it's so crazy that TSYX is actually third place at a negative $41.03. So that boost is not done well. We'll see as if it recovers back. Like they have always said, that boost has helped the recovery, and we'll see if that does anything with it. So with that will close out this week's recap. So quickly is call for any feedback in the next steps. We've selected our ETFs, as we said. We're going to always ask this: there's one you think we should be swapping out? Should we something new that's on the horizon that you think was doing well? Should we add the YMAX, the YMAG into it? The drip strategy. We did this. You guys asked for it. We did it. And again, series interest, we're going to continue doing this across the board. I want to thank you for your input. I love what you have. Leave the comments below. I know this is a short, quick video, but let's see how we do next week, and we'll see you then.